So the second factor we're going to look at in terms of the impact on consumption is interest rates. As we said before, interest rates basically are the cost of borrowing. And that's either the cost to you of borrowing money from the bank, or of course it's the cost to the bank of borrowing your money. If you put your money in the bank, then you get savings interest. Interest rates rise and fall. They can be influenced by central banks and by other factors in markets, depending on kind of levels of competition between banks and so on. And we'll come back to that later. So for now, though, let's imagine that interest rates were to fall. In principle, that makes borrowing cheaper, and therefore, what we'd be expecting to see an increase in consumption overall. And we'd be likely to see an increase in consumption overall for three main reasons. So a decrease in interest rates, we're saying, is expected to lead to an increase in the overall level of consumption. For three basic reasons, I think. Then there are probably others as well, the two big ones. Firstly, obviously, like we just said, the cost of credit is lower. It's cheaper to use your credit card. It's cheaper to get an iPhone on hire purchase, on credit, to borrow money for a new car, all those sorts of things. The interest rate is lower, therefore you have to pay less back. Therefore, a cut in interest rates will have an impact, particularly in this way, on kind of things that we tend to buy on credit using loans. Kind of sofas, cars, expensive stuff, sometimes called consumer durables. Secondly, and probably the biggest effect in the UK, is the impact on mortgages. It varies by country, but in the UK, a lot of people have loans to buy their houses. There are two types of loans. There's a variable rate loan, or sometimes called a tracker mortgage, and fixed rate loans. Variable rates go up and down when the Bank of England changes its interest rate. Fixed ones don't in the short term, but they do. They're only fixed for a certain period of time, 2, 3, 5 years. If interest rates fall, then so too do mortgage rates. And that has an impact on current mortgage holders. People who have variable rates are affected immediately. People with fixed rates, there are always some people who are coming to the end of their period of fix. And therefore when they take out a new mortgage, then they'll have either a higher or lower, in this case, interest rate. What that does is it immediately increases what's called your discretionary income. Because your mortgage payments are less, you have more money to spend on all sorts of other things. I remember during the financial crisis, the interest rate on our mortgage dropped from 5% to 2%. And as a result of which, we had about £400 a month more just to spend. And this is one of the biggest effects of interest rates. It's just that automatically people with loans, mortgage loans, house loans, they pay less back to the bank each month, and therefore they have more to spend on going out and other goods and services and so on. And the third effect is the one that students love, which is they say that a cut in interest rates will lead to a decrease in savings, which is possibly true. I mean, it's not true for me. For me, I need to retire one day, and therefore, when interest rates have gone down, that's made it harder for me to build up the amount of money that I'm going to need to retire. Therefore, I've actually saved more. However, the standard theory is a cut in interest rates will reduce savings. But I would be cautious with that one. So, is this So generally speaking, a cut in interest rates would be expected to boost consumption. So why might it not be so? What might our worries be? I mean, one is obviously that kind of savings effect. Other things you might tend to think about is that interest rates, they tend only to have small changes. So therefore it may take time for people to notice. Generally the Bank of England or other central banks, they change them by about 0.25% at a time. Which isn't big news for anybody. And as a result, partly because of that, there are likely to be time lags. It takes people time to notice, even on your mortgage payments, it takes time to notice, that your mortgage interest payments are lower or higher than they were. Yeah, obviously, a lot of this is to do with taking out loans, and therefore consumer confidence is likely to have an impact. If confidence is low, even if interest rates are low, you're not going to simply borrow a load of money. And also, the actions of banks. So there are certain interest rates, particularly on credit cards, that don't seem to vary very much. So even when normal interest rates go down, interest rates on mortgages go down. The central bank cuts its interest rates on mortgages go down. There are some interest rates that don't seem to be affected, so therefore it's not necessarily going to have an effect across the whole system. But generally, we'd expect to see a cut in interest rates should boost consumption, and therefore, when the economy is doing badly, when the economy is in recession, that's one of the responses that central banks tend to make: cut interest rates, to make it cheaper to borrow, to reduce people's loan repayments, and in principle, to create a disincentive to save.